The following overview is from an actual client. The strategy works well for both Generation X and the Millennials, and because of this, I think it should be of interest to you. Paul and his wife are expecting their first child, and in anticipation of their first child, he is looking to protect his family should he pass away. At the same time, he is concerned about the ever-increasing costs of health care for his family. To provide for his family and leave enough income for the next 30 years, he needs $2.6 million in death benefits. Of that total need, we recommended approximately 10% be guaranteed death benefit product with a cash value growth based on various market indices. Also, in order to hedge against inflation, we chose a 30-year term policy for the other 90% instead of laddering term portfolio where the total death benefit would decline as he got closer and closer to retirement. If Paul passes away before retiring at age 66, his family will receive $2.6 million in order to maintain their lifestyle. And after 30 years, the hybrid policy is paid up but will continue to ensure he gets approximately twice what he paid in over those 30 years. That $250,000 will be received either via $10,000 per month of long-term care benefits or a death benefit, or a combination of the two. Either way, the money is received income tax-free. Of course, given Paul's age, he's not at all worried about the prospect of paying for long-term care, although maybe he should be, since approximately 41% of individuals receiving long-term care support are under age 65. Having said that, chances are he will not be in a nursing home, and the $10,000 a month may only be enough to cover home health care by the time he needs it. However, when he actually does decide to purchase long-term care in the future, his hybrid policy will allow him to choose an additional long-term care policy that has a longer waiting period. This extended waiting period will help offset the higher premiums associated with his then older age. As an aside, over the years, Paul's premiums are expected to have grown and created a pot of money called cash value, which he may access on a tax-free basis via policy loans. In a sense, his premiums have capitalized a personal bank which can lend him money at extremely favorable rates. Thus, he has access to emergency cash should he ever need it, regardless of his FICO score. In addition to covering long-term care as a way to protect his investment portfolio, we also recommend the Obamagap solution. The Obamagap solution comes in two parts. Part A is insurance coverage which pays Paul cash if he's ever in an accident. These payments can be used to offset the high deductibles and copays associated with lower premium bronze and silver plans via Obamacare. Part B is insurance which pays Paul a check if he ever has a serious health event such as a major burn or stroke or heart attack, cancer, etc. Again, these payments can be used to cover the out-of-pocket expenses associated with his Obamacare policy. In short, we call this portfolio insurance since he pays healthcare costs with the insurance money instead of his own portfolio. And then lastly, because we've alleviated much or all of his income and health risks, it is expected that Paul's portfolio may be managed more aggressively, and since he is many years ahead of him, this should lead to a greater account value by the time he retires. The previous slide was full of information, so I want to take a brief moment to summarize what you've just heard. Paul has enough insurance during his working years to ensure that his family maintains their lifestyle. After he retires, he will still have a $250,000 policy which is guaranteed to last until he's well over 100 years old, even though he's no longer paying premiums. Also, the policy builds cash values which he may access on a tax-free basis via policy loans and very favorable terms. In addition, if he ever needs long-term care support, the policy will pay as much as $10,000 per month for those expenses. The second component is the Obamagap solution, which helps cover substantial financial gaps resulting from the new Obamacare policies. In the end, what we've created is an insurance program which protects his investment portfolio during both the accumulation phase and the distribution or retirement phase. Because when things go wrong, he will no longer need to tap into that portfolio. As you can see, effective risk management is the key foundation to a successful long-term investing plan and a happy retirement. As a successful Gen Xer or Millennial, it would behoove you to see how affordable a risk-managed plan would be for your own particular situation. For a complimentary review, please contact us via email or phone. Thank you for your time.